Hi, I'm Randolph Clements. Today we're here to discuss the current market conditions. I have the National Bank executives with me today. On my right, of course, is Calvin Cordell of the private banking sector and Brett Moore from the business banking sector. Calvin, so what is the main differences today in the banking sector with the current interest rates?
Well, I think over the last 12 months, the story has really been about the interest rate environment and how that's impacted the property market. We've seen unprecedented high and fast increases in interest rates over the last 12 months, but they are still at historic lows. The RBA cash rate now at 3.6%. And so it's less about how high that is at an absolute level, but the speed in which those increases have occurred. And that has, of course, cooled the property market quite significantly over the last 12 months. Mind you, off a very positive couple of years that we've had, not just through COVID, but going into the COVID period, the property market has been running quite hot, and we've definitely seen that cool the last 12 months.
Well, from my point of view, I can certainly say that when you consider what happened from 1990, when a property in the northern suburbs around $100,000 had dropped 40% to $60,000, and there were many, many buyers then holding off for the market to even drop further. Within a few short years, the market absolutely took off again. In fact, we've had rises for the last 20 years. Interest rates had peaked at around 18%. So interest rates today at 3.6 and being passed on to consumers at around 5 point something is incredibly still low. And I actually feel that whilst vendors are holding off and buyers are holding off at the moment, it will take off in the very close future. I think things will settle down and the market will start ticking off again. What do you think, Brett?
Yeah, I think certainly from the bank's perspective, Randolph, we are keen to ensure that our clients, our customers, have the capacity to repay, and so serviceability is a really big requirement for us. And as inflation continues to rise, clearly we're seeing the RBA doing everything they can, as Calvin mentioned before, with the rapid rise in interest rates to stem inflation, but as just the general cost of living rises, I think we're seeing a more cautious consumer, a more prudent consumer, and someone that is and a population waiting to see where and when the interest rate cycle will peak.
Can I pick up on this point, Randolph? Because I think there's two key themes that are going on at the moment, which is cooling the market. One is a technical and one is a sentimental point. So how are people feeling? On the technical, right, so this comes to the interest rate question. There's the actual interest rate you'll pay, which we just talked about is the RBA cash rate plus a bit of a margin that most banks will take. But at the same time, all banks, all regulated banks need to add a buffer. And at the moment, that's a 3% interest rate buffer on top of the actual interest rate that you'll pay. And if your actual interest rate is 5.5%, then your actual 3% buffer on top of that is 8.5%. That's quite a large interest rate relative to where we've come from in the very recent past. That is reducing affordability by up to 30%. So you were going to buy, you thought you had a budget for $1 million for a home. It's actually now less than $700,000. And that's the technical impact that's had on the market. And so people are stepping back and saying, well, have I got enough of a deposit? Should I wait? And people are stepping back. And that brings me to the second point, the sentiment that's out in the market. And that is definitely cool. People are less concerned about FOMO, fear of missing out, and more cautious, definitely, in their thinking. That's what we're seeing.
Our chief economist, Randolph, Alan Oster, refers to economics as the study of applied psychology. So to the point Kelvin just made, people will look at the objective numbers, their serviceability, and then this question of emotion and sentiment comes in terms of what they're comfortable, their individual risk profiles in a market that we find ourselves in at the moment.
So the big question will be, when will that sentiment change and roll through? And a question for you, Randolph, because you're really on the ground and your agents are every day picking up on that sentiment. What's your views around when is that going to occur, do you think?
Well, what I've been noticing is that good properties, even right now, are selling very well. And one suburb to the other, there's the difference. Some suburbs are feeling the pinch. Some suburbs are not. Personal friend of mine recently bought a property short of $5 million, and there were several buyers wanting to buy it. The current market did not make any difference. The current interest rates did not make any difference. I feel that buyers, if they want to buy and they want to wait, they should buy, in my opinion, by the end of this financial year, because the adjustments will be made this is just my gut feeling, the adjustments will be made within the next 6 months. People will settle down. They will understand what the interest rates are. They'll get used to it. They got used to it in the 90s. They got used to like 16 to 18%. They will get used to this. There'll be things that people will start to cut away and save on. Smashed avocados, breakfast with smashed avocados at Friday, Saturday and Sunday, trips away, all of that sort of stuff. People will have to make certain adjustments to save money.
I'll make no comment about smashed avo on toast. I don't know if we'll live.
Randolph, can I just pick up on one of the points you made then about market sentiment and one of the things that we're seeing, and I think you touched on this before, Kelvin, is averages are crude, and so we've seen, according to our economics team, property prices in the cities of Australia come off by about 9.6% in recent times. That's off a 25% increase, though, through that COVID period. So I do think not all markets are created equally, and there will be pockets of opportunity for buyers. And it comes back to that question before in terms of cutting your cloth according to your circumstances, which is so important.
Cutting your coat according to your cloth.
That's correct.
So can I pick up on that point? So that's right, Brett. In regional areas, prices are off a little bit less than that, so about 7.5%, but they've been up 41%.
That's right.
Over the last couple of years. So we see that difference between metro and regional. But the other thing is different types of properties. And Randolph, you made this point earlier about premium prestige properties versus more affordable end. And in the private bank, we see that a lot. So the luxury, real prestige end of the market is definitely strong, and that's continued to be strong. That's often a little pocket on its own. The more premium market, so the top quartile, has come off, has eased, prices have eased a lot more. Then the affordable end has held up probably better. And a lot of that comes down to discretionary versus non-discretionary. Am I buying an investment property versus, a family home? So I think, again, back to that point about different markets are dynamic and they actually all behave in slightly different ways.
And there is a dynamic also happening right now. Whilst regional Victoria took off and people went out to the regions to live, but were working in the inner city, with petrol prices going up, they're now thinking about coming back in. So that wave might actually change again. Gentlemen, tell us, what are the short and long-term trends in the property market?
Thank you, Randolph. I mean, it's a fascinating question, isn't it? There's a lot that I think still needs to wash through this year ahead of us. We talked about the impacts that interest rates have had on the property market, and I think this coming year ahead is all about the inflation and interest rate story. So we know that if the RBA needs to continue to move rates very quickly, then that is going to continue to cool the market. National Australia Bank expects another 3 interest rate rises throughout the course of this year that will take it over 4%. But there is clearly downside risk on that if inflation continues to stay high. So that's a big one to watch ahead of us. I think, but what we are seeing that's more supportive of the property market, though, is the migration story. So we've heard a lot recently about overseas students coming back into the market. That's certainly supportive of, say, the apartment market. The rental market, of course, which is very strong, but from a sales perspective, the apartment market, and of course the structural undersupply, there's just not enough homes for us to live in. And over the short to longer term, that is going to put a that's going to be supportive for the
Yeah,
market.
just to add to that, Kelvin, I think particularly Randolph in Melbourne, where there's a structural mismatch in terms of what we need in terms of population growth to support this economy in this city, which is predicted to be bigger than Sydney by the end of the decade, and what we actually have on the ground. So, given the situation with rates, commercial real estate developers looking at whether or not some transactions stack up at the moment, given rate rises, costs of input costs, some recent supply chain challenges. We need those transactions and those buildings built. They have to make sense clearly for the developers taking the risk on, but to meet the needs in the coming years of the population, particularly in Melbourne. Population growth.
When you said 3 interest rate rises by the end of this year, are you talking about 20.25 basis points each time?
Yes. So a total of 0.75%. That's our official forecast. But as I said, it could be higher. There's a lot of unknowns here because we just don't know how persistent inflation is going to be.
So, Brett, what is the broader outlook for the country this year?
Yeah, again, our formal position from the economics team is that the Australian economy would grow by about 0.7% this year, which is off considerably in recent years, but it's still growth, Randolph, when we look at other economies around the world that are going backwards. Our New Zealand friends over the Tasman are experiencing some really challenging circumstances that they're predicted to go back by about 1.3% in terms of growth this year. And that's before the cyclone hit tragically last week. So more moderate, muted growth for the Australian economy. But when you look at that relative to the challenges the world's facing at the moment, still opportunity, but just not what we've seen over the last couple of years.
With the comment that you made, Kelvin, about overseas students coming to Australia and requiring accommodation, how do you feel that if the Melbourne City Council allowed a lot of the space that's lying in the city out here, office space that's lying in the city out here vacant, to allow a lot of the space to be turned into residential? And if it was, wouldn't that go towards the problem of accommodation, especially for a lot of the students that are coming in?
So I think that's a great question, Randolph, and I think that's one that should be looked at. What we do know, I'll make 2 points on it. What we do know is that there is a real challenge with converting most commercial office buildings. They're not the way the floor plates are designed, the way the services are designed is specifically for commercial property, and it doesn't necessarily translate well to residential, or the cost and expense of doing so is substantial, and sometimes as much as a complete rebuild. So there are some challenges around that, particularly with older commercial properties. I think the general point, though, you make is certainly valid, which is that there is a planning challenge here. So how do you fix some of these issues around undersupply, which is a very live question, and a lot of sort of state and federal government and Treasury are thinking about this problem and looking at it certainly from a funding perspective. But I think it's important that we think about it from a planning and zoning perspective as well.
Yeah.
How can we best use our land and existing property, if that is appropriate to do so, to put more supply into the market?
So, Calvin, people looking to enter the market at the moment, what advice would you give them?
Well, I wouldn't presume to give individuals specific advice, and that's certainly not our role as the bank. But what I would say is, and perhaps maybe I would say this, but work with your bank. Sit down and do your budgets, do your planning, work out what you can afford, and as I say, work with your bank. I run the private bank. Any of my bankers would be happy to talk to you if that's sort of the space that you look at, or you can go onto your NAB online banking app and you can actually book a home loan appointment. You can sit down with a home loan expert who will help you work out your budgets and what you can afford. So that's the first and most fundamental question. Work out what your budget is, and then look at the market accordingly. It's very easy to get over-obsessed with prices. Should I wait 6 months because I might get a slightly better deal? And they're good questions, but I think individual needs and individual circumstances are most important. Are you looking for a family home? What's right for you over the long term? Think about those things, and then, as I say, be really careful with your budgeting.
You made the observation before, Randolph, about various property cycles, and just to pick up on Kelvin's point then, I think particularly for those who are purchasing a home, looking at the long term and looking through the cycle, knowing that you've done the work about affordability and being able to purchase subject to your capacity to meet the needs of any loan obligation you've got against the property. So, but again, prices come up and down. You've experienced that as an agent over many years. But looking through that longer term, particularly for the family home.
Yep. Look, I make the point again, and I go back to the 90s again, when many buyers were waiting for that extra $10,000, that $100,000 property that came down to $60,000. They were waiting for that extra $10,000 to come down, and they missed the boat. That same property that came down to $60,000 is around $1.2 million in the northern suburbs today. That extra 10, if they paid it and didn't miss the market, they would have made all that capital gain. So you've got to be very careful as to how you pick the very bottom of the market. So I think the best time to buy is when you find the right property right now and you negotiate and you buy. That's my point.
What's going through the heads of your vendors and/or potential vendors and/or buyers that we haven't covered so far?
Well, I think potential vendors at the moment, there are many vendors that, they're concerned that maybe friends and certain family members of theirs got a very good price last year, 12 months ago, 8 months ago, 6 months ago. They feel their property is worth better than the other property. They want to get that extra money today. My advice to them is the best time to sell is in fact right now, because when you come back on the market, sure, you've got that little bit less and you will negotiate to buy the next property, especially if you get a negotiation where it's 10% deposit and 120 days or even 150 days, giving you 5 months to find the right property. As interest rates increase and should prices then come down, you'll buy very well. So that's my advice to vendors, not to be too tied up and too hung up about maybe getting a lesser price today, because you will actually buy very well when you're a cash buyer, when your property is sold. Yeah.
We know the market's driven by fear and greed, right? So we've come out of a market that's been greed-driven, that's been FOMO-driven. I think to Randolph's point, we're in a little bit of a fear environment at the moment. So I'm scared as a vendor that I might get a lower price than I would have done last year, and I feel bad about that. Or a lower price than I might get if I wait a year. And then it's sort of a standoff, because we've then got buyers saying, well, I might get a better price if I wait for another year. Now that has to change,
And you'll be paying a better price as well. By waiting and you get a better price, the bare fact is that you'll end up paying a better price. So that's why I say the best time to sell is right now.
I come back to the previous point we've made, which is that we can get a bit over-obsessed with price and trying to pick the very bottom or the very top, depending on if we're a buyer or a seller. Actually focus, the most important thing is to focus on your needs, the needs of you and your family. Where are you with your life? Is it about buying a family home? And have you worked out what you can afford? And then move forward with confidence. That's more important, I think, than getting overly obsessed by it.
No, it's a good point, Randolph. I think certainly surrounding yourself with people and advisors that can give you the best perspective to ensure that you're most informed in these really dynamic times, whether that is your real estate agent, whether it's your accountant, your financial planner, your banker, critically important. And not just the technical advice, but working with people that you trust in a genuine partnership, a bit like I'd say, Randolph, we've got.
Well, as I've said in the past, as far as we're concerned with Rain & Horn, we've been with the bank now for the last 40 years. I have, in fact, had one of the best business banking managers that's looking after us, and that is Philip Pleasant George. Excellent man. Returns his phone calls by the end of the day. Returns his phone calls within 5 or 10 minutes sometimes. So we're very happy with the National Bank. Kelvin, what is the forecast, the bank's forecast for the next, let's say, 12 to 18 months?
Thanks, Randolph. It's a good question.
Also, real estate prices there.
Right. Yeah, terrific question. So what we're seeing at the moment, I'll just give you a couple of stats. Certainly what's happening right now is listings are at historic lows. So what we saw in January was listings are down 14% versus what they've been on average over the last 5 years. So that's a significant fall. However, there are some early stats in February that's starting to pick up, or at least the rate of decline is easing. Our official forecast for 2023 for Victorian property prices, remember that's an average across the whole state, but the official forecast is a fall in prices by 12.5%.
I would challenge you on that. I don't think it'll be 12.5% fall.
What do you see?
I think, as I said earlier on, I think that the real estate market will bounce back. People will settle into the interest rate, the current interest rate, and even the increases that you're talking about. And I think Australians have an insatiable appetite to buy. And I say that because when you consider that on Boxing Day, they'll be there at 5 o'clock in the morning at Myers and David Jones to rush in, crash through the doors, fight with people, grab stuff, and buy, because they have this insatiable appetite to buy. They don't care what they buy as long as it's a bargain. That's what's going to happen when things settle down and the market will kick off again. I don't think we're going to see 12.5%.
No, I like the challenge. I think our role is to, based on what we're seeing, we get a heck of a lot of transactional data through our systems, and obviously we have a large business and loan book that we can look at, and our economics team will then do their forecasting. As I mentioned before, economics is the study of applied psychology. So it's with that input data that the economists then provide the forecast that Kelvin spoke to before. But well and truly entitled to your perspective.
I want to ask a question.
Yes.
For how long has the RBA threatening that interest rates were going to rise? Has it been for the last 6 months, or has it been even longer than that? Were they talking last year about interest rates rising? Because about 2 months or 3 months prior to the election, the first interest rate rise happened. Now, when we had all the lockdowns, we were saying that the real estate market was going to die. As soon as, just after the first lockdown, as soon as we opened up, the real estate market took off. Because you can only hold people back for so long, and they had all this pent-up desire to buy. That's why I say, in Australia, we have an insatiable appetite to buy real estate. And as soon as they were let up, the market took off. And that's why I say when interest rates finally settle down, we will find that the market will take off again.
Let me make a couple of points. I think it's certainly the case there are plenty of market commentators that see less of a fall than the 12.5% that NAB is forecasting. There's probably, I would say, market consensus that it will be less bad than that. I think a lot depends on the inflation, because that drives what the RBA needs to do. So I think that's the big thing.
Well, and I'd probably add to that unemployment as well, Kelvin.
Well, that's
yeah.
I do think that the recovery or the turnaround when it happens will be quick because of, as we talked about before, the structural undersupply. So I think whenever the turnaround happens, it will be quick. Just to pick up on another one of your previous points, Randolph, and your question around last year, when did the RBA start signalling this would happen? Now, of course, Governor of the RBA has apologised in the past about a year or two ago, saying that rates would not move until 2024, and he acknowledges that was perhaps a mistake. Signalling is really important, right? Because we do know that drives sentiment. So I don't know when they would have first started changing that messaging a year ago, but if we look at what is the messaging now, I think that's what's interesting. And certainly the messaging, and even at the last board meeting they met a few weeks ago, the debate was not whether to move interest rates or not. It was whether to move it 0.5% or 0.25. Now, they decided 0.25.
Yep.
But what it signals, and indeed what the messaging is that there is a fairly substantial more rate increases to come throughout this year.
I think the other point, Randolph, to acknowledge is that monetary policy, the impact of monetary policy on the economy is, talking to our team, a 12 to 18 months lag period. So the actions taken now will only see the impact of in the broader economy 12 to 18 months hence. Mm.
Adding to that, talking about the job situation, they're encouraging a lot of overseas students to come in, and they'll take up a lot of the casual work out there. So how do you feel about that?
So that is a really important dynamic. So we are seeing an increase in migration as the COVID pandemic winds off, and certainly the overseas students, and the particularly the Chinese students has been in the media a lot recently. So we do expect to see a big influx of them, and that will support the job market, but of course support the housing market as well. The
Indian students as well.
Yes, a range of overseas students. The other dynamic that's playing out, though, is as the RBA continues to increase rates, remember they are trying to cool the economy. Now, we have seen a very hot jobs market the last 12, 18 months, as we know, and so it's been very hard for businesses in most sectors to get the staff they need. Early signs, recent job ads, the Seek job ad data that we saw the last, I think it was yesterday, is that job ads have come off slightly. And again, you would expect to see that happen as the RBA is deliberately trying to cool the economy to curb inflation. You would expect to see less job ads and unemployment start to tick up slowly. And of course, that will happen as that'll be exacerbated by incoming migration as well.
Yeah.